Mayuresh, what do you think? I mean, it's getting bad. Could it get ugly? Could this bitter get ugly?
Afternoon, Nikunj. No, I think two, three angles. One, obviously, in terms of how global macros are shaping up. The expectations in terms of the China stimulus, as you put in, has clearly buoyed sentiments in terms of foreign flows towards China. Again, undervalued, under-owned. And therefore, the kind of move that we saw in the Chinese markets because of the stimulus was something to be watched out for. The second element, obviously, is the US data points as well from a macro standpoint. Have been relatively stable so far. So all indicators are probably indicating that data point should be reasonably stable enough going forward. Even in the earnings context, our US team feels that earnings might be a little bit soft as far as Q2 and Q3 numbers are concerned. But Q1 of the next financial or calendar year will also probably start indicating better earnings coming in for a large part of US Inc. The Japanese change of leadership created some jitters as well, Nikunj. But again, I think the statements thereof that he's going to take it very, very easy as far as monetary policy is concerned has again probably just soothed some sentiments. Obviously, I think the 2 points that you put across, if this escalates in terms of the Middle East conflict, the large unknown is to what extent can this happen. I think that's where the markets are probably fearing at this juncture. And even in our own context, as far as earnings are concerned, earnings might be a tad bit soft going into this quarter's numbers as well. But with good monsoons, expectations of rural recovery, second half should be relatively better as far as India Inc. is concerned. So again, not looking at a structural downside, liquidity remains strong, and therefore any fall in the market that probably comes through, liquidity might come back and cushion them.
HDFC Bank 2.5% lower, Adani Enterprises 2% lower. Mayuresh, let's take that point slightly further, which we were discussing with Kunal, that we've got a big heavyweight which is down. That's Reliance, 4%. Should we take it casually, or this could have serious ramifications? Nuresh.
So we are back to the same prices. If you look at it, say on June 4th, we made a bottom around 2,700 to 2,750, close around 2,800 on Reliance Industries. So we are going back to June 4th, which is an equivalent of sub 24,000 Nifty. So that tells you one part of the index is actually getting into a zone where it becomes an interesting buy. And so eventually we may not go back to similar 200-day moving average for the Nifty, but stocks may go there and create an opportunity. And it's a flow-based move, and we've seen that it gets adjusted really fast. And we'll have the Chinese markets open also next week. So this could continue for 2-3 more sessions. But overall, would be looking out for opportunities in something like a Reliance rather than getting scared of it.
Mayuresh, how would you map today's selling in Reliance in isolation? I mean, I'm not obsessed with Reliance or something, just that it is happening that I've said Reliance 20 times in 20 minutes.
Two aspects to this, Nikunj. I think one, in terms of their core oil and gas business, Singapore GRMs have been extremely, extremely weak for the quarter gone by. And therefore, the upstream business that Reliance probably carries, there will be some elements of softness reported in those numbers. Again, in terms of their petchem business as well, the downstream product business where the spreads specifically for the end selling prices seems to be soft as well. Petchem might also be a little bit soft. To their support, I think the retail businesses might just stand up, both in terms of how Reliance Retail is expected to perform, as well as Jio in terms of both the subscriber addition that we've probably seen and the expectations in terms of stable numbers from them as well. So I think the retail businesses should hold up, but the upstream and the petchem business should probably be soft, which balances out the expected earnings trajectory for Reliance, at least for this quarter and the next quarter as well. So I think the markets are going into Reliance's earnings, expecting that they will be soft this time.
Just looking at some of the other, key laggards as well in trade. There's, of course, BPCL, there's Axis, there's Shriram, which is down about 4.5%. Tata Motors has slid a good 4% as well. Even L&T now lower by about 4%. Maruti, there's, of course, Reliance, which we've been flagging off, Bajaj Finance, there's Wipro, Adani Ports, Kotak Bank, HDFC Bank. All of it is seeing some pressure points. Even metals, Kunal, right? They've come off from their day's highs. I mean, yes, they're in the green, JSW, Jindal, Tata Steel, but definitely off from the day's peak.
Yeah, so you might see some bit of profit booking over here, but I think till the time you see stocks like JSW Steel, Jindal Steel, Nalco to a larger extent, when the stocks hold on to the breakouts, show a price performance of a positive 3%, 4% on an average on such kind of market days, I think that's generally an indicator that the trend is here to sustain as well as build. And I think I've been maintaining this stance over the last 1 month that the only two stocks which are strong enough from the entire pack is JSW and Jindal Steel, and the third one which is coming back into a breakout mode after almost I think 8-9 months of consolidation is Vedanta. I think these are the three names which I would want to concentrate on from the metal pack. So my expectation is that the rally and the trend is here to sustain as well as build, and I think one should be focusing on top three names in the metal pack.
I'll give you another example as to how markets are just not differentiating between right and wrong. Now, if China does well, metals are doing well, logic. If China does well, then Tata Motors should also do well, because JLR gets a lion amount of business from JLR, but that is falling because of global factors. That is falling because of Middle East. Metals are going up because of China. So it's a strange market where you're finding a variety of reasons to ascribe to where things are. But is the bull run in autos getting over? Mayuresh, this is one big surprise pack for me. For the entire month of September, we kept on flagging off that boss discounts have started. Car companies are no longer enjoying pricing power. Now the Dussehra sales also are pretty much endorsing the same. Why are auto stocks still holding on? They've hardly corrected, despite the fact that discounts have started and the margins would be down in the Dussehra and Diwali season.
So to that extent, Nikunj, I think the expectations that the last 2 years have been extremely strong for most auto companies, whether it's two-wheelers, four-wheelers, truck makers have been laggards of sorts, but at least for two-wheelers and four-wheelers, the last 2 years have been exceptional. Obviously, I think with the base that they're probably carrying and the expectations of whatever launches have taken place in the past few quarters have really worked well for auto companies. But I think they are going through a phase of consolidation at this juncture. A large element on the expectations of earnings upside, specifically for both two-wheelers and four-wheelers over the next couple of years, lays on the base fact that more launches expected over the next few quarters. Electric launches specifically, two-wheelers, four-wheelers, the platforms that they're coming out with are expected to keep their new launch sales quite buoyant. Along with that, the expectation largely that is getting penciled in as well is that pricing might again, which was probably a constraint for some fence sitters, as the rate cut scenario starts coming in place, at least for the higher price or the premium price cars, it'll be a little bit more affordable with rate cuts coming through to probably own a premium vehicle as far as four-wheelers are concerned, and even the higher premium range of two-wheelers as well. So I think second half is where I think some element of earning stability should come in. And next year, I think the markets are banking on the fact that with new launches, numbers should normalize and start improving as far as earnings are concerned. Valuations through the roof, Nikunj, absolutely, for both two-wheelers as well as four-wheelers. And therefore, I think one should be a little bit more circumspect and careful in choosing what you're picking within this space.
This is where things are stacked up in terms of the mid. It is not very, very bad. Let me put it this way. Two more stocks, Naresh, which have been the poster boys of this bull market, and they've retreated very, very sharply. REC and PFC. In REC and PFC, Naresh, is this a good time to buy the decline, or again these are trends which have changed in favor of trends which have changed for a long period of time?
Looking at the way the whole power pack has been holding on, doesn't look like PFC, REC could go into a sharp correction. So if you look at smaller power companies are also doing well, being the lenders to the sector. And technically, they've gone, both these names have been in a consolidation as well. So for example, if you look at PFC, the stock was at the same prices of 480, 500 in February of this year. So it's been a no return period for last 6-8 months. Same is the case with an REC. So given that the consolidation is still in play, would like to buy it on the lower end of the range. So something like 450 odd levels for REC and something like 420, 440 levels for PFC. That could be an entry point. Or one could go staggered going forward. But as of now, at current levels, would wait out and say wait for some more correction, but not looking at it as a stock which would top out soon.
2%, it is not a very scary fall. You want to mark Europe, whatever is available. You definitely want to bring out Asia, because in Asia, Hong Kong is down, China is closed. That's also worth revisiting. And metals are holding on.
Europe is down quite a fair bit actually. We're down over 100 points for DAX. The CAC is also down about 1% or so. 192 points gone for the FTSE MIB and the Stock 600 as well. Of course, our markets I think would be the region underperformers. But yeah, and Hong Kong also down about almost 1.5% there. But yeah, Europe and even US futures, they too are seeing weakness. And that's the thing, right, Nikunj? What we're seeing right now is pretty much a global move, and I don't think there would be clarity until the world markets stall and then you see a recovery coming in. Right now, we're still pretty much getting swept away.
Yeah, Aisha, money moving into China means that markets are rotating from an expensive market to an underperforming market. If it was like a global tsunami against equities, then all markets would have fallen down and China would have fallen the first. So the fact that sectoral rotation has started, it is country rotation which has started, but money is moving into risk. All of us thought that India, being the pedestal positioning it is enjoying, it will get lion's share of inflows because Fed will cut rates, money will move to emerging markets, India would get the optical benefit of that. That has gone to China. Has it got permanently to China? Very difficult to say. But the kind of falls what we've seen, now think from an institutional standpoint, yes, suddenly markets will start looking attractive. Imagine Reliance at 200 DMA. Imagine banks have not gone anywhere. PSU stocks have corrected enough. Autos, Tata Motor, what was the high? 1,000? 1100 has become how much?
930.
I'm just putting some context here that a lot of these stocks have already started correcting. So it's not that everything in the market is euphoric. Yeah, you got pockets in SME, you got pockets in IPO, you got a lot of stuff which is expensive. But when you see this kind of a nasty correction, you actually would have to take a step back and say, okay, I'll wait and I'll see where I'm getting value in this market. At some point in time, Idea Vodafone will also start looking attractive because the debt has become, it's fallen so much. So when you see a correction like this, I think these are times when you would say that, okay, thank God this correction has happened, otherwise this market would have got bloated. So these markets are not seeing what could be called as if risk-off moment where everything gets plastered. If it was a mandate to sell equities, then China would have fallen flat by now because that's the weakest market.
But China is not trading right now.
No, I'm just saying, I'm saying that if this was a mandate for risk-off. Second, crude is behaving itself. So it may just end up being a pinprick. We had similar situation same time last year. We didn't talk about it, but markets have lived through it. So if this ends up becoming a pinprick from Middle East, then crude will settle at 73, 74, which is where it was always settled. We got that brief moment of 4-5 follow drop, so it settles there. Early indications of festival season are not bad. Hotel booking, DLF we spoke to. So it's not looking that bad at all. And then on top of that, mutual funds are sitting on cash, NFOs are on, and domestic liquidity is strong. So to make a case that, okay, we peaked out for the year, I think it'll be too early. It may happen, I don't know. But I'm saying that based on what we have today, I think in a day or two, this storm may just settle down.
Yeah. And even if it happens, I mean, even if we've seen the best levels for this year so far, it's not really that bad because remember, you've got two very large IPOs as well, which are still to come before the year closes in, both Hyundai as well as Swiggy.
Yeah, so I think I saw the market last Friday and last Thursday, and it was up 20% for the year. 20% for the year.
It's fabulous returns.
It is fabulous returns.
Yeah.
I mean, this fabulous return at the beginning of the year, we had projected that the market will give you no returns. From no returns, which was the general strategy call by every brokerage who gave you a target of 18,500 to 21,000. Right? That was, we started the year at those levels. Right? Just correct me if I'm wrong.
Yeah, so I think for the Nifty we started closer to 21,000.
18,000 to 21,000 was the range.
Yeah,
Everyone
correct.
said that between 18.5 to 21 this market would move for the entire year. Where are we standing? We are standing 4,000 point above what the consensus number was. So we should be mighty happy and delighted that this market has been far more rewarding than we thought. And individual stocks, Aisha, they've just hit out of the park.
I was just going to come to that 20% is just the index. What about those individual stocks?
It's been a very good year. It's been a very good year, and we are not done with the year. You never know that October, November, December, the last hurrah in the market could still be left. I mean, why are we saying it's peak for the year?
Yeah, no, I'm just saying that even if it is, it's really not bad. Worst case scenario, if we saw the best last week, it's still not bad.
You don't want to end the market on like a euphoric high, then 2025 becomes a terrible year to reckon with. You want some fear in the market because, what I've learned over the years is that markets are like a cardiogram beat, always goes up and down. What you don't want is a flat line. So you don't want, that's dead actually. Mayuresh Joshi? come in on this engaging conversation with your headphone on.
I've taken it off. There are a lot
Okay,
of
that's
planes
why I
going
prompted
over
you.
my
That's
head.
why I prompted you.
A lot of planes going over my head. No, so yeah, I think ifs and buts for the market. But again, I think the consensus call here is that corporate earnings should improve in the second half. Mutual funds, a lot of domestic institutions are there on the sidelines. The IPOs that Ayesha was talking about, I think there is plenty of appetite in the market in terms of liquidity. And therefore, I think if liquidity gets sucked off because of these IPOs, does not seem to be the case with the Indian ecosystem at the moment. And China, I think, are there genuine signs of recovery? I think we just had a call at the beginning of this week with our Chinese team as well. And they are hopeful, but they are not 100% convinced that internal data points are suggesting to a genuine growth kind of a dynamic playing out in China. So a lot of factors are pointing that if correction does come through, I think quality stocks will again be looked at and should be looked at by long-term investors.
Okay, before we close in for the day, let me just take in some BTST ideas as well. Or Naresh, is it going to be STBT?
So a mix of both a sell and a buy. First would be a sell on Cummins India. The stock has made a lot of tops around 3,900 and breaking down now. Stop loss at 3,750, target price of 3,550. A defensive buy on Dr. Reddy's, which is holding on. Stop loss at 6,700, target price of 6,900.
Okay, Kunal, what's on your list?
I'll go with a couple of buys, two buys over here. So the first is about TCS. After quite some time, the stock forming a bottom at 4,200 mark. So look at targets of 4,340, stop loss at 4,160. And the second is about Bombay Dyeing. That's a chart which is looking very attractive at 230 plus mark where it's trading. Buy with a target of 248, stop loss at 223.
Kunal, thematically though, whenever the market recovers today, tomorrow, next week, or whenever it is, what's going to be the first recovery sector? Is it going to be steel or other metals? Because, that's where you're seeing a meaningful move, and more importantly, sentiment-led.
See, in the last 5 attempts of the markets going to this 5% correction, every single time we've seen new sectors emerging. So in fact, in the previous last 2 attempts, for example, two attempts back, the index saw major change where we saw the PSU stocks which are outperforming. They went to a huge underperforming spree. There was a sharp profit booking, selling into these stocks. What rose up, were the likes of IT, autos, as well as the pharma, IT, FMCG, and pharma spaces. In the recent month, in the month of September, when the markets went to such kind of a correction, we saw the emergence of metal stocks and the banking index, which made a comeback. Now, so far, it looks like that the metal index is the one of the strongest one. But only over the next 1 or 2 weeks, once the selling settles down, is where clarity emerges in terms of which is the next sector to look out for. So I think I would not be preempting the move over here, but over the next 1 week, if there is any kind of a strength in terms of relative momentum building upon those sectors, I think one should try and position over there.
Okay, let me hand it over to Ashesha then to wind up how this Thursday has been. But Kunal, Naresh, Mayuresh, all of you, thank you so much for your time.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.